Episode 12 with the Winning Wealth Podcast. In today's episode, we're going to talk about raising money, how to go out, bring outside money in to grow your portfolio in real estate or in any other business. Quick disclaimer, any advice we give here is not legal advice. We aren't attorneys. This is just our general advice of what we've experienced in going out and raising money. Tune in to hear the rest. Thanks.
So let's jump right into it then. We're going to be talking today about capital raising and syndications. So might as well start off and just talk about what does that mean anyways? Well, what is a syndication? A syndication is essentially a partnership between a group of investors that are essentially pooling together funds, knowledge, resources, and sort of acumen around the deal. You can syndicate any type of deal. You do oil syndications, you do real estate, commercial real estate syndications. You can syndicate all different types of things. But essentially, it's a sophisticated form of a partnership to essentially go out and do a deal together. And we'll talk through today throughout just the various different roles of a syndication, and specifically in capital raising.
Maybe quickly explain to you like the difference between general partner and limited partner. Like there's the general partnership group.
Yep.
And we can use an example of our business, right? Myself, you, and our third partner, Adam, we're the general partners. We go out, find the deals, get the bank to bring the debt on the deals. We sign our name on the debt. We do all of the work. And then we go out and bring the money in from limited partners.
Limited partner investors that want to be hands-off.
Completely hands-off.
They're still getting, they're still partners in the deal. They get all the same tax benefits that we would get. They get, and they just get essentially, cash flow tax benefits that pass through onto them. They get a K-1. They're limited partner investors that don't have to do anything really in the deal other than bring the money together. And
the question is, why would we do all the work and they do none of the work and get all the benefit?
Because then there's a portion of equity, or what they call a promote. Not to get too advanced here. I'm trying to think through who's going to be listening to this. We want to make sure this is valuable for everybody. But essentially, the reason that you would do that somebody would invest in a deal and be hands off, essentially you're giving up a portion of the equity in the deal and the upside in the deal to the general partners or the operating partners, the sponsors they call them in the deal, to be able to go out and make sure that deal performs well. They're doing the asset management. They're taking on the risk of guaranteeing loans. Sometimes if it's recourse or if it's non-recourse, then there's no guarantee in the loan. But essentially, they're putting up more of the risk and putting up the knowledge and the effort, the sweat equity, and we put our own money into the deals too. But which most general partnership groups do put their own capital in as well, and then they'll raise the money, and they'll look at what we call a capital stack. Essentially, all the different forms of capital and funds that you need to put together a deal. And so that's starts with debt. Usually it's senior secured debt, by, that's collateralized by a property. And the first position on that is usually the bank. But then that goes down into various forms of debt, and then equity, depending on the deal and the project. I don't want to get too too in depth on that, but essentially that's the capital stack. As anyone that's a general partner or an operating partner or a key sponsor of a deal, no matter what type of deal that is, you've got to figure out, okay, what funds does it take and what blend of debt and equity does it take to get this deal done and to be able to go execute the business plan.
Yeah, I would say a quick example too of when you're explaining the general partnership, like what we stand to make for doing all the work you described, is an example could be we're taking 30% of think of it as free equity for doing all the work. And if we can go out, buy a property, add value, and 5 years from now we sell it for $1 million more, we're taking $300,000 home for the general partnership group. That's kind of there's a million ways to structure the deal, and we don't want to get too in depth on structures. Maybe that's a future episode, but that's why we do all the work, right? We get that upside, we get some fees along the way as well, It's a very lucrative business for both sides, the limited partner and general partnership group.
Yeah, and I think the key too is to, we talk about this, I feel like in every episode we've done. I think this is episode 12 now, which we're having fun with this thing, but the key is aligning interests and making sure that, hey, if we really kill it in a deal and our investors make a lot of money, we get sort of compensated alongside of that. And we invest on the limited partner side and then run the deal on the general partner side, do the asset management, oversee the business plan, and then from there, we take a portion of that upside for doing the deal. And so for anyone that wants to get out there, and this episode is going to be more about the capital raising portion of it, and putting that capital stack together. But before anyone wants to go out and be a general partner, or raise capital, raise funds for whatever project that they might be doing. It could be, like I said, it can be real estate, it can be a nonprofit, it can be something that you're really passionate about, or it can be a business venture, right? But before you raise any money or go seek out capital for your project, the number one thing you got to do is get educated, right? You got to know that business really well. You got to essentially be an expert in that field, or be partnered with experts, but you got to really know what you're talking about. And this isn't, there's rules behind it too, but this is just our perspective on how you should go about this. And so, I was, just to talk about our experience before, and hold on, I don't want to jump ahead of it. The second thing you would do before raising any money is developing some sort of a track record. And so I'll talk through that here, but both you and I, and we had bought a number of duplexes and smaller properties on our own capital, our own, risk. We went and got the loan, got the insurance, did the property management. I was managing, a bunch of units, while working a job and doing that. And then, so that was developing a track record. Hey, I've done this before with smaller apartment buildings. Now we're going to go do this with bigger properties. And it's essentially the same thing, but the reason that you would do that is because you can get economies of scale, right? It can, essentially it can be more cost effective to manage a bigger property on a per unit basis or a per square foot basis than it would be to manage a smaller property because of the economies of scale. And so, but along with that, I remember I made a definitive call in, I think it was late 2018. Shout out to Jake and Gino and the guys at Wheelbarrow Profits. Before I went and raised, partnered with any limited partners or took on any outside capital to do a deal, I joined this national mastermind group called Wheelbarrow Profits. And essentially, and that costs money. But it's essentially you get a course where you get to learn, you get coaching, you get guidance and help with a lot of the different things that you're going to do. And then, I went out and did, another deal that was a joint venture, and it wasn't a syndication deal where we raised money from limited partners, but I wanted to kind of prove out that business model and then feel comfortable going out to my contacts, friends, family, network, and saying, hey, I've got a deal. We've put the pieces in place and the infrastructure in place to be able to create deal flow, whether that's relationships with brokers or, a lot of groups will send out mailers or just driving for dollars and finding, properties that you might want to buy or a deal that you might want to do. I'd already had the network or the infrastructure and the education and the track record in place that people were saying to me, hey, dude, I want to do a deal with you. And so then I would basically, even then, because the number one rule is you don't want to lose anyone. You don't want to lose your own money, but you definitely don't want to lose somebody else's money, especially if it's friends or family, right? You could be sitting at Thanksgiving or Christmas, and that can make for some awkward holidays. But if you're doing all the right things, there's risk in deals no matter what. But if you're doing the right things, you go out and get educated, you build a track record, and then as part of that track record, maybe you develop like a portfolio deck or some sort of thing to say. And it doesn't even, your track record doesn't need to necessarily be like, I've done this exact type of deal, But if you can look at, hey, I've had success in business, maybe in in your corporate career, or that all plays into it. Like it's who you are as a person too. If you've had success throughout your life, if you've overcome adversity and challenges, and you've worked through those things, and you've had a lot of, you've had significant wins along the way, and this is something that you're interested in, and it translates over, right? That's all part of the track record too.
Yeah, because I think from a perspective of a limited partner, right? If you went to someone asking for money to invest in your deal, right, and you've never really done a deal before, and so this is my first deal, and yeah, you kind of just have this dream of going out and buy it. Like sometimes you can convince them, right? If they're a close friend or family, that's usually where you start with. But on the flip side, if there's someone else who's done 50 deals, has a big track record, doing it for a long time, you're going to be more enticed to invest in the person has the track record, right? So I think if you're listening to this, like saying this is the business I want to do, I want to raise money to go out and buy big properties, really take a step back and start with educating yourself and try to go out and buy a duplex or buy a smaller property first, build that foundation, and then that translates much easier into going out and raising money.
100%. But I think, you get educated, you can prove that you've gotten educated on this, you can prove that you've done similar deals maybe at a smaller level, and then on top of that you've done a lot of other things that would translate to success in this type of deal. You're going to be well on your way to putting together that capital stack and finding these opportunities. And by the way, that matters for the bank too. We're not just talking about like raising money from your friends and family and asking them to pitch in for your deal. I'm talking about also with the bank. The banks don't want to lend money to someone no matter what, right? Even if I had, say I wanted to go buy a $10 million property and say I had $3 million liquid and say this was, 5 years ago or 10 years ago or whatever, and I didn't have any experience whatsoever, the bank would not lend money to me to go buy a building, right? They want to see a track record. They want to see that you've been able to, even if you have the money, right? They want to see that you're going to be able to, and the bank's usually the number one partner in your deal, right? Like they're usually the biggest part of your capital stack, whether that's 60 or 70%, loan to the value of the property. Or the cost of the property, depending on what you're doing. But so they want to see that you have a plan in place and that you've been able to execute on certain things like that.
Yeah, and I think to take that a little further, right? There's two parties in the deal, right? There's the deal provider and the cash provider, and we could talk about like who, of course, the deal provider is the general partnership group that's going out finding the deals, doing all the work, and then there's the cash provider who's the passive investor again. So as you're thinking through, right, I think when you're getting into real estate, you're thinking through which side do I want to be on, right? I think the deal provider is generally someone that wants to build a real estate business, be very actively involved, and that's their main thing, right? On the other side, there's the cash provider who might be, has a great job or has a different business, doesn't want to spend the time to go out and learn real estate and put all the hours into learning it, finding deals, but they can just write a check and be passively involved. Those are really the two different paths there are, I think, when it comes to identifying like how do you want to get involved in real estate. These are your two paths.
And sometimes those even get blended. Sometimes those can be a very, the cash provider could be a very seasoned real estate professional that now just wants to be hands off, right? It's very multifaceted. It could be somebody that's getting to retirement age. He's someone that he or she knows the value of real estate. They know the business well. These are good people to look for because they, you don't need to, sell the value of being invested into real estate deals. If it's someone that has already had success in real estate, they know the business, they just don't really want to be hands-on managing the asset, then, they're a great person because you don't need to necessarily get them up the learning curve. But another other examples of cash providers, and that can be, again, it could be a bank, right? The bank is someone that's going to provide cash to go buy a building. It can be someone that's a high net worth individual that's liquid, has a lot of capital to deploy. They want to figure out where they're going to allocate that capital to. Like you said, it could be someone with a great job, high income earner, somebody that has had an inheritance or a recent windfall of cash and they're not sure what they want to do with it, and somebody that has self-directed IRAs. So say, you maybe see the returns that you're getting in your IRA or your 401k. There's programs in place that you could self-direct those retirement accounts into different deals that you think, if you really believe in the business plan. And so those are the reason we wanted to go through those, is just so that you can get your mind around what types of individuals could I be looking for to help me put a deal together.
And where would you say, like, you're going to go out, okay, you want to go out and raise money for the deal, you've identified that. Where are you going to try to find the money?
Well, what I said there too, right, is, I mean, the number one thing is you have to pay attention to the learning curve, right? Like, if someone has no idea, even if they have a lot of money, right, and they have no idea about the value of investing in real estate, and they just, there's a lot to learn there. So, and whether it's real estate or whether it's you want to, go start a business or something, or go buy a company, if the people that you're seeking to invest in your project, if they don't have any sort of background knowledge or understanding of that business model, it's going to be a lot harder to get them up through the learning curve, because you're going to have to spend a ton of time with them, educating them on what the value is to them, how it would be a great, potentially a great return on their money, on their investment, and why it makes sense that you would be the one doing that deal.
And I think too, when you're starting off raising capital, your first capital raise comes from people that know and trust you. So this could be family and friends, it's often referred to. So people in your network, could be a colleague for work, someone you've known for a long time, someone that knows you and that is going to trust you to deploy their capital, because they might not look as much as at your track record in comparison to the fact that they know and trust you.
Yeah.
So starting with that network of people and going all in from raising capital from that source, to me, is the easiest way to start.
Yeah. And so you just think about your current network, your Rolodex, right? Like, here's the people that know me, friends, family, hopefully they think highly of you, your professions, your job, people that you've worked with for a long time that can, that know your level of professionalism, your ability to execute, in a work setting. It can also be just, hobbies, people that have known you from the country club, right? They're golfing with you. Brock's the club champ, by the way, so he's going to get a lot of that. But, somebody that has the same interests as you do, gets to know you well. That's a good place to look. And then just networking events. Like for us in real estate, if you go to different real estate conferences, there's already people there that are also trying to network, and they might be looking for people that are trying to do deals.
Yeah. So I think a good, as you're thinking through, could I go out and raise capital? A good mental exercise would be, who do you know in your network already that knows and trusts you that could write a check to invest, right? And think through, okay, these 5 people, maybe roughly they could write this big of a check, and maybe even have conversations with them to get an idea of how much money you could raise. That's a great place to start, instead of going into it thinking, I'll find the investors as it comes, right? And I'll make some posts online and source the money from online. To me, that's kind of a next step thing, is you start with that group again that already knows and trusts you. And then as you grow and do more deals, then you start getting referrals, you start doing stuff online, people start reaching out to you. But I wouldn't expect that from the first deal, right? You kind of have to go after that initial group first.
And capital raising, so those of you that know me, know my background in sales. I've been very passionate about it for basically since I got out of college. And so, capital raising is sales. You're selling the different parties involved to help put together this capital stack so you can go execute your project. And so in sales, we talk about our power base a lot. Like, that can be current clients, that already know you, that are working with you. So, but if in capital raising, it's who's your power base, who knows you the best, thinks the highest of you, that would be potentially interested in this. And then once you build that power base up, you can work that power base up for referrals to other people that they know. And that works much better than trying to go out and say, crowdsource a deal from a bunch of people that have no idea who you are online, right?
Yep. So let's talk about the 2 different types of structures, right? So there's debt and equity investors.
Yeah.
So let's start with that. I can talk to the debt side. So that's someone that's essentially not taking equity or upside in the deal. They're just going to write a check in the deal and say, I want a fixed 10% return on that. And you're just paying them a 10% return on their money, no matter what. If you sell the deal for $1 million more, that's all yours. You just have to pay them that set number. So that's bringing, so that, hard money is a common structure for that, where you can go and find a hard money lender and they might charge you 10 or 12%. And you pay them that on a yearly basis. Yeah. And as soon as you can cash them out and give them their initial cash in plus that 10 to 12%, they're out of the deal, right? Yep. You get to keep all the equity. So that's one way to do it. And then,
and why would some, so it's, first of all, that's super popular right now, or becoming very popular, given this interest rate climate that we're in, right? Interest rates went from historic lows to doubling over the last, year and a half, 2 years, whatever. And, so nowadays there's more and more debt, private debt lenders out there. Not necessarily the banks are at this time in September of 23 that we're recording this, they're a little bit more gun shy to figure out what's going to happen with the interest rate climate, but that opens up opportunities for someone that has money out there that wants to just say, look, I'll be the private debt on this deal. And so if you or I wanted to go out and flip a house, right, and we couldn't get a bank to do that deal for whatever reason, maybe they couldn't buy into the deal. Maybe somebody that has a lot of money will say, yeah, I'll do that deal for 10% or 12%, fixed interest. And then if you can go out and do the deal and make it successful, you don't end up giving away any of your upside in the deal, but you're taking on a higher interest rate to get that capital to go out and do that. It's a very common way for people to start in the real estate business.
Exactly. Yeah, I'd say that the pros of it, like you said, are you're not giving up equity. You get to keep all the equity in the deal, which equity is great, right? The more equity you can have, the better. The cons are you contractually owe that person or investor, whatever it is, 10, 12%, and you have to pay them that no matter what, right? So if the deal doesn't perform and only throws off 6%, you're either compounding that or you're coming out of pocket to cover that difference. So there's more pressure for sure taking on debt investors, but you get to guard more equity for yourself.
For sure. The other, other than private debt, then it'd be private equity, right? And that's a number of different ways to look at that. They're usually strategic partners. They're very aligned on interests in the deal, the business plan. They want to see it succeed because the better that deal does, the better their equity does. The equity of their investment can compound and grow. This is typically seen in like turnkey rentals, buy and hold projects, right? Where you're, raising equity, from partners, joint ventures, syndications like we were talking about, real estate funds. And this is typically, it can be done so many different ways, and we're trying to keep it really simple. So you can do a straight just, 50-50 split on equity. Hey, I'm going to go out and I'm going to do this project, and we're going to do this deal, and then at some point in the future when we sell it, after we execute our business plan, we're going to split the returns 50-50, right? You put up the cash, I did all the work. That's one way to do it. If you get more sophisticated, you can get into things called like preferred returns, where the equity that comes into the deal, the people that provide most of the cash for the deal will get the first 8% as a preferred return of any of the capital, and after that, then you start to split it a certain way, whether that's 80-20, 70-30, 50-50, and there's different. Another thing is very sophisticated, but it gets into waterfalls. So essentially, if the deal sponsor goes out and really kills it, a waterfall would say that if they're going to hit a certain return metric, the better that return metric gets, the more that equity split changes from something that is better for the sponsor too. And that what that does is it really does align interests, right? If you go out and kill it, and you really execute your business plan, you did what you said you're going to do, and the deal's just a rock star home run, you're able to then get more of the upside, but it's still a huge win for the equity investor.
Yeah, I think compared to debt, right? Like as we said, debt, the investor might be expecting 10 to 12% a year fixed, whereas with the equity, you might only be getting 6 to 8% in the beginning, right?
Yeah.
But you're waiting for that exit of a refinance or a sale to really get your big pop. So that's so I would say from a general partnership perspective, the pros of bringing on equity instead of debt are as you're less under the gun, right? If it doesn't perform in the first couple of years, doesn't cash flow as much, you have time to make that up on the exit, and you're not accumulating owed to the investors. The con is you're giving up equity, right? So you're taking away some of your equity and giving it to the investors, some of the upside. So for us, all of our deals have been that structure, right? We do private equity. We give investors an equity stake in the deal, because to me, it's easier to raise capital with that structure, I think, because you're offering upside to the investor. You're saying, hey, we're going to do these 3 things, and you're going to get the upside when we sell the deal. We're not just going to cash you out on the debt side. You're going to get the upside.
Yeah, and I would say, though, no matter what, it makes sense to look at the capital stack as a whole, and any deal that you're trying to do, try to figure out what blend of debt and equity is going to make the most sense for it. I'm trying to make it so that it's, I'm talking in terms of, if we're not talking real estate, if we're talking different deals, maybe it makes sense to have, a debt investor. If you know that there's a ton of upside, and for example, say you're buying a business and you know that business is, you strongly believe that you can operate that business to cash flow really, really well, maybe giving away 10 or 12%, it's not going to matter that much, because your cash on cash return when you're operating the business fully supports that. And then you're going to be able to take some more of the upside. So it just depends. It's trying to find the right blend of debt and equity for your deal. Why don't we talk about the systems and processes?
Yeah. So
Brock is our systems and processes guru. He's our guy.
So yeah, like some tools you could use to make raising capital easier, right? Creating systems out of it. A CRM, I think, is huge, right? That could start off as, in the beginning, it was just a spreadsheet, like tracking every time you have a conversation with someone. Hey, this person said they were interested in investing. Instead of just like mentally remembering it, it's going to get to a point where you don't remember it and you're going to lose track of people. Start storing that information, right? It can be as simple as their name, email address, and maybe some notes. So for us, it started as a spreadsheet. Now we use HubSpot and have a big CRM of all the data of investors. So when it comes time to go out and raise capital for a deal, we have an email list ready already. It's as simple as sending out an email to that list and using that. We can keep notes of what investors said and kind of use that as a central spot. So I think having some sort of CRM is super crucial when it comes to raising capital. That to me, that's the big. There's other things that you grow into, like we have investor portals and different tools for growing that. But start with creating a centralized database of all the people you've had conversations with that are interested in investing.
Absolutely. So other sort of processes and just strategies, for building out an investor database would be, thought leadership, blog posts, doing a podcast, doing events. We started an event in Wisconsin. I don't even know how long ago?
Like 2019.
Yeah, it's 4 or 5 years ago now. Called Wisconsin Apartment Investors, and we always made sure to have a lot of fun with it, and made it so that it wasn't kind of a stuffy networking environment. But we did that, and because of that, we were putting on the event. There was people that would come up to us and say, "Yeah, we're interested in investing. Let us know if you have any deals." Boom. Then they go into your CRM. You start to create different newsletters, different blog posts to stay top of mind. And then when you have a deal, they've already expressed interest in potentially investing in your deal. And you can then
nurture it and get it invested. And I think that event we started, right? We used to do a monthly networking event at our office in Waukesha, and that was where we got a lot of our initial investors in our deals, and that kind of sprung where we are.
Yep.
So I think when we would throw these events, it was once a month. We'd bring in a speaker, we'd pay for drinks and pizza. It was a free event, and I remember a lot of times people were like, why are you paying? It'd be at least a couple $100 each time we would do it. Like,
pizza,
why are you paying
beer,
for this?
yeah.
You could charge people $20 to come in.
Yeah.
It's like, we don't really care. Like, we'd rather spend a couple $100, build the relationship, because then if they come in and we can raise $1 million from this group, the upside on that is much greater than a $20 entrance fee.
Yeah, 100%. The key there is just to network, and then have those systems and that infrastructure in place to be able to capitalize on that when you are out looking for deals.
And always be telling people what you do, right? So when, a general conversation when you're meeting someone is, what do you do for a living, right? Well, I invest in real estate. I partner with other investors alongside them, and we go out and buy properties.
Exactly.
And you'd be amazed how many times like, what does that mean? You explain further what the business is, and a good amount of times they're like, well, I'd be interested in learning more about that. I've always wanted to invest in real estate, but I figured I had to go out and be a landlord. I don't want to do that. Yeah. Okay, great. Get their contact information, nurture that, rinse and repeat, continue to do that, and all of a sudden you grow a pretty big investor base.
Exactly. And just to reiterate here too, I know we said it in the intro, this is not legal advice. This is not a solicitation or anything like that. This is simply just talking through the processes of raising capital for whatever deals that you might want to do. But so when you are there is legal guidelines and laws in place that you can't just go out and solicit your deal from anyone ever. I meet the guy he's in front of me at the coffee shop, and I'm like, hey dude, I got this deal. You want to invest it? That's illegal. You can't do that, right? You have to have a relationship with these people. A great way to build a relationship with them, if you don't already know them, is by having a meetup like we did at that point. And so you have that. They get to know you. You meet them a certain amount of times. You set up a conversation with them. They express interest. Everybody wants, if you're interested in that space, people want to see deal flow. It's just what they want. They want to see, hey, what are the deals going on? What could I potentially get involved in, right? It's kind of like curious, And then they get to know you more. They like you. They trust you. And boom, it might be your next big partner in a deal.
Quote Sam Zell, tell me about your deals.
Tell me about your deals, Sam Zell.
All right, so let's talk about the difference between. So there's a lot of structures when it comes to syndication, but the two most common are called 506B and 506C. So 506B is that's what we do.
Not lawyers here at all.
This isn't legal advice.
A lot of money.
High level.
By the way, great shout out, Dan.
High level description of what it is, right? So there's with a 506B structure, you're allowed to bring in accredited and non-accredited investors. So accredited investor is someone that's made over $200,000 for the past 2 years or has $1 million net worth excluding their primary residence. So that's an accredited investor. So what 506B allows for is you can bring in accredited and non-accredited. So anyone else can invest. So it opens up the pool to anyone. The downside,
sophisticated investor.
Sophisticated, which is pretty much checking a box saying that you can make your own decisions. But the downside to it is you can't openly advertise. You have to have an existing relationship with the person. And a relationship means, again, this is our thoughts on it and what we know about it is you've met them a few times, right? It doesn't have to mean you grew up with this person or they're, your parents or whatever. It's you've met them a few times. So for me, that means, okay, if I meet someone at a networking event, I set up a call with them, we exchange some texts and emails, that's considered a relationship. Now you can pitch them on the deal. So you can't pitch them right away. You can't post online about it. You want to invest in my deal. That's not allowed in a 506B. And this is really where you start with, right? Is because again, raising capital in your first one generally comes from family and friends. You have a relationship, you can raise capital from them, and there's a good chance most of them are non-accredited. So that's 506B.
And this is like, so once you're going to go do your deal, right? You get your legal docs and structure all set up. You figure out with your attorney what's going to make the most sense. If you do a Reg D 506B deal, as Brock said, you can't go just post it online, right? And say, hey, I'm on Facebook, I'm on Instagram, I'm on TikTok, I'm doing a dance, and I'm like, hey, go look at my deal, and everybody can get into it. That's against the law. You can't do that. You can't go pitch, openly solicit and advertise for deals.
Exactly. And then the flip side of that is 506C, which you can do that. So with 506C, you can blast it out everywhere. You can put up a billboard, you can post it on Facebook, whatever you want, but all the investors have to be accredited. So again, have to make over $200K for the last 2 years or $1 million net worth, excluding their primary residence. So that allows you to advertise as much as you want, but your investor base is going to be a little bit smaller, right? Because not everyone's accredited. So that's the decision process you generally have to choose is which one do you want to go after ahead of time before you start advertising. And again, the trajectory you usually see is you start with 506B, so that way you can raise money from people that you already know, even if they're not accredited. And then you graduate into the realm of now I solely advertise to accredited investors.
Exactly. Very common. Lastly, we'll just go through some capital raising resources. Some of my favorite books, and probably, the person I pay the most attention to in this space is Richard Wilson. He started the Family Office Club. He's a beast. He's great. Shout out to them. He has a book literally called Capital Raising. And what I love about his books are they're all like really, really short, to the point, concise. You can read it in a day, right? And he's got books about a number of different things in the space of capital raising, but my favorite one is just called Capital Raising. We'll link to it, right? Maybe in the show notes. I don't know if people are saying that we got to do more links and stuff like that. Another book for these two are specifically real estate related. One is by Matt Faircloth called Raising Private Capital, and the other one is by Hunter Thompson called Raising Capital for Real Estate. Those are real estate specific books to learn if you want to raise capital for real estate deals. And then
I would throw in too, I like it's not solely for raising capital, but Syndication, Best Ever Apartment Syndication by Joe Fraley is like the textbook for syndication. That's a great place to start. I always tell people if you're trying to get into syndication, start with that book.
That's a that's a Bible of syndication for real estate. And shout out to them too. He's great. Other resources that you can look at if you're looking to raise capital. There's familyoffices.com. Again, that's by Richard Wilson and his team. That's like kind of a network of folks that are trying to invest and do deals. And so that's a great place. Biggerpockets.com. If you're into real estate, you can find, Brock and I met on BiggerPockets. You can find anybody that, you need to find to do deals in real estate. If you have literally zero connections, but you want to do it, get into real estate, you can probably find them on BiggerPockets. That's investors. That's, agents, bankers, down the list.
We've made a lot of money through. We've bought deals through BiggerPockets.
Yeah.
Found investors. It's a great platform. I post on it every day. Like, it's a great platform that I think if you're in real estate, you should look into it for sure.
Yep. Awesome. That was a wrap there. Episode 12. We did all about raising capital for whatever types of deals that you want to go out and do, whether that's buying real estate or whatever business project that you want to execute. We talked about the capital stack in general, debt, equity, different types of private debt, private equity, different structures and systems and processes for executing those strategies. So great episode. It's crucial for everybody to learn how to. There's enough money on this planet to go out and fund anyone's dreams. So as long as you have the knowledge behind it and the systems and process how to do that, you're going to be successful. Hope you enjoyed it. Smash the like button and let us know. Share it with your friends. Let us know if you have any feedback. Thanks so much for listening.